So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the FICO podcast. Welcome back. Merrill Chandler here, your host of FICO. And in this episode, we're literally going to talk about how merchants use their knowledge of different credit scores to rip you off and charge you the highest possible interest rate. So we will be right back. Welcome back, guys. Are you aware that big ticket merchants, auto dealers, mortgage companies, Winnebago salesmen, luxury car salesmen and women, these guys know the funding game better than you do, such that they are aware of how to use your ignorance against you and to create a vast higher profits for them because you don't know what's going on, right? So today we're talking about how those big ticket ripoffs, and they're using FICO score versions. Now, you may not even be aware that FICO has versions. In previous episodes, I talked about that there is the equivalent of a software version like, Windows 98 versus Windows 10, right? For you Mac users, that's like Windows Lion versus Windows Mojave. So these score versions create a nightmare for us and big profits for them. So that's what we're going to be talking about today. Now, one of the things we need to be aware of is that FICO is about predictive analytics. We know them for credit scores, right? We know that they're all about credit scores. That's all we've heard. But they are far beyond just financial or credit scoring. They have a whole bunch of other products that they offer industries. Now let's take a look at some of those. Those industries, there are 83 total FICO algorithms that are sold to industries. So we have the FICO score, but then there's the FICO application score, which we'll be doing a deeper dive on in a different episode. But that FICO application score measures the difference between the data in your application and the data that the bureaus and all the databases that they're checking against to see if you're really who you say you are. It's called the application score. Then we're going to be talking about it in an episode very soon about the revenue score. Did you know that FICO actually can take your credit score and your zip code and determine how much a lender is going to make off of you? No joke, right? We'll be talking about that later. Then there's a FICO fraud score. That's how fraudulent is this application as a percentage, right? Then there's FICO pre-score. Now, FICO pre-score, we're going to be covering in a different episode as well, but FICO pre-score is what it determines what mailing list and what offers they send you. And we're going to talk a huge discovery about how you're actually lowering your score by being on these lists. But FICO does a pre-score. Then there's FICO Small Business Scoring Service. We've talked about that, the SBSS. That small business scoring service is FICO taking over the entire business funding marketplace with their score compared to PayDex, compared to all those other more primitive and archaic and ancient versions of business scoring, right? It's the only real legitimate business scoring metric out there. Then there are other scores beyond the credit related, beyond the financial. There are FICO insurance scores, and there's FICO propensity scores for healthcare. What is your propensity? They use the Medical Information Bureau to actually measure how healthy you are and prone to injury or illness. Imagine that. Predictive analytics, the propensity towards health or propensity towards accident or illness. They're measuring this stuff, guys. Come on. We'll be doing an entire episode on that. Property predictor insurance scores. FICO measures what kind of, it's like the propensity score, but how often is a homeowner going to tap their insurance, for their homeowner insurance? How often are they going to say that something got stolen or some? Those are all in the predictor insurance scores. Then there's the FICO debt management solutions. So they have a score that actually manages or predicts the tendency towards default and bankruptcy. And that debt management, when is a particular borrower overwhelmed? When are they tapped out in their utilization, their balances, too much consumer debt, etc. Then they have the FICO collection score, which is how many collections do you have over your lifetime? And some of these scores, remember, since it's not credit reporting, they don't necessarily fall under the protection of the Fair Credit Reporting Act. So because they're predicting the future of a particular borrower, etc. And then notice they even know how to optimize for mortgage pricing, what to give a borrower for pricing when they're applying for a mortgage. So all of these scores are being our behavior, our borrower behavior, and our consumer behavior and our insurance behaviors. Everything is subject to this big data predictive analytics. All right. So now let's dial this down from those 83 and let's go to what's the 28 scores that we get to focus on as part of our fundability. All right. So there are 28 consumer facing scores. Some of them are weighted and some of them are unweighted. We're going to define that right now. So a weighted score means that they give a higher value in the algorithm to your previous behavior, good or bad, a higher weighted value to your previous behavior in each of these industries. So an auto-weighted score means that they're going to check out how well you've performed on previous automobile loans. A weighted mortgage, all mortgage scores are weighted, just like all auto scores are weighted. But the weighted score is how well you've done on your previous mortgages. Have you missed payments? Have you been behind? And they're measuring if you've been a day late on your payment, or have you paid late fees and been 15 days late? It doesn't have to go all the way to 30 days loss. They're weighting how you perform on that loan. Remember how we called it performance data? This is where they're measuring how we are performing on these previous loans. There's weighted personal credit cards and weighted business credit cards called bank card scores. These are all weighted scores. All right. Now, then there are unweighted scores, and these unweighted scores are marketing scores. And we're going to be going deep into this, and then we're going to find out how they're being used against you. Now, the two unweighted scores are over here. So Chase, Bank of America, Wells Fargo, all of these unweighted scores, there's two versions of it. Now, when I say versions, I'm talking software versions. There's unweighted 8 and unweighted 9. And we'll talk about that in just a second. But I want to focus. I'm going to do a deeper dive on the unweighted scores, because these are consumer goodwill. It's like, hey, aren't we awesome? We're hooking you up and telling you your credit score for free. All these guys are doing it now. It's the next big thing in credit scores. But they got slapped down because they were pretending that these unweighted scores are scores that lenders use in business decisions. And I'm here to tell you right now that only weighted scores are used in business lending decisions and personal lending decisions. Only the weighted scores. So let's take a look at this. Let's look at the number one place where you get access to the the unweighted score. So remember those scores you get from your lenders? All right, those scores, the very first question you have to ask is it a FICO score? Does it have the FICO registered trademark? Because if it's not registered trademark, then it's what I call, forgive the language, guys, but it's a FICO score. But these unweighted scores are FICO scores, meaning, and what do I mean? Do a quiz. What do I mean by a FICO score? A FICO score is any score that is not used by a lender for a lending decision. Okay? So FICO has a FICO score. That's the marketing score. And then there's all the other FICO scores, right? So is it a FICO score? Does it have the FICO logo? And then what version of the software? Now, on my personal credit, Chase just stopped subscribing to FICO and went to Vantage. So that's a FICO score because nobody uses Vantage. 2 to 3% of lending decisions based on Vantage. The other 95 plus are all based on FICO. All right. So we're going to talk about right now about the FICO score. Now, I'm going to do a deep dive here, and I recommend that you guys either watch the video version of this next, or when you're not driving, or when it's safe to do so, watch the video version because I've got some compelling graphics. Or you're going to find these same graphics when you go to fundinghackers.com and click on the blog. Find this episode, and that whole blog information will be there as well, and these graphics will be there as well. All right. So take a look at this. But I'm going to explain it to you so you understand as clearly what we're looking at if you're in drive time or otherwise working out and you're listening to this episode. Now, I'm looking at a Bank America online banking, and it says FICO score. View your FICO score. Now, from the previous episode, what is that? What's the first thing that they're implying that is not true? View your FICO score. It doesn't say view one of your FICO scores. It certainly doesn't say view your unweighted FICO score that no lenders use. Notice that language isn't there. It says view your FICO score because they want you to believe that this is a meaningful score, because if it's a meaningful score, they're hooking you up. They're solid. They're a great little lender to take care of you so well. All right? I call bullshit. Let's find out more. So it says your FICO score. Then it says FICO scores. Now notice there's a trademark that says the score lenders use. It doesn't say FICO scores. It doesn't say the scores lenders use. It's still implying there's one score. There has never been a mortgage done, I believe, under heaven in the history of mortgages where they didn't pull all three bureaus, guys. They pull all three bureaus. This is not okay. They're not disclosing the full truth but it's all marketing. It's all marketing. All right. So I gotta be able to read the screen. So we may have glare as a result on this episode. So the score lenders use, but they get to say it because it's a trademark. You get to say anything. You can say the world's best friend, TM. You may not be the world's best friend, but you get to say it if it's a trademark. So they're saying the score lenders use. Then on this example, it says 680, and the credit rating is good, right? Now, let's get into the fine print. The first things first. Notice it says, as of 4/19/2017. As of 4/19. So this score, everything that we're going to talk about is only good as of this moment. Then your FICO score 8. Now they've declared, remember there's unweighted scores. The FICO scores is FICO 8 and FICO 9 have unweighted scores. Your FICO score 8 is based on TransUnion data. So they're finally telling us, oh, what bureau? Oh, there's 2 other bureaus? Why aren't you telling me what those are? Well, that would be more expensive to get those scores as well. But the issue is that they're saying that they're already in this fine print. They are not disclosing the full truth, right? So let's take a look at the next thing. They're saying this is provided for educational purposes only. Provided for your educational use, not to compare to what your lenders are going to pull. This is an educational credit score, which we should read as worthless compared to what a lender is going to pull. You follow me? Okay, next, it's different from other FICO scores. This FICO score may be different than other versions of FICO scores or other credit scores used for educational purposes. So they're saying this FICO score is worthless, and it may be used against other FICO scores that are also worthless, because we're not interested in education. We're interested in what is the lender looking at, and am I going to be approved? That's what fundability is. Are you following me? Right? So this is complete BS, guys. But we don't even know what the fine print means. Are you with me? We have no clue what the fine print even means. That's why that's what RUFable is all about, right? Because excuse the impertinence, but RUFable means are you fundable? But it also means that can we take it up the hindquarters if we don't know what we're doing? Yes. We are getting totally abused by the system because we are ignorant. You don't know what's going on out there, and I'm trying to tell you by their documentation exactly what game is afoot and how we should play it, right? So this score may be different from other versions of FICO scores or other credit scores used for educational purposes. That's what FICO means. You read educational purposes and just replace it with the word fake, okay? Variations may also occur when your score is based on data from other consumer reporting, from other credit bureaus, different from scores based on data from other credit bureaus, and the data from other consumer reporting agencies or calculated at a different time. You guys may have had the same experience. My students and clients all have. What is insane, guys, is that one day later, so much may happen on a credit profile that your score may be up 10 or 20 or down 10 or 20 points by one day. If it crosses a billing cycle, if you paid off a utilization, there's a number of reasons why your score goes up or down. So they had to put in here that as of 4/19, this was the truth of your fake unweighted FICO 8 score. Are you with me here, guys? Are you understanding what this is all about, right? All of these disclaimers. Do you know why they have to put these disclaimers in here? Because in the previous episode, we showed that I believe it was Experian and Equifax both got sued for pretending to give a consumer, a borrower, a score that was meaningful to the lender. And they got sued and they lost. And as a result, every single notification of a score has to have disclosing information. Well, yay, bravo. But guess what? Until now, I know you've been getting free scores. They've been doing this for a couple years now. But have you read the fine print? Or have you been filtering it saying, oh, yeah, it's my score. Here's my score. Oh, look at this. I'm a 680. I'm a 720. I'm an 820. And you don't even know what that means. And you didn't know how to filter it because you don't know what a fake score is. You don't know what educational scores actually mean. And now you do. Guys, now you do. This is so badass because what you can do with this information, I'm going to show you exactly what you can do with this information. Let's take a look. Now, unweighted versions of the score. There are two of them. There's FICO 8 and FICO 9. So what I'm showing on my screen, for those of you who are watching the visual, go watch the visual version, guys. If you can, watch it on your phone while you're working out. Don't watch it while you're driving, but make sure that you watch it, or at least go watch look at the blog on fundinghackers.com. Click on the blog in the menu and navigation. You're gonna see all of this, right? Notice that there's an 11-point difference between the Equifax and FICO 8 and the FICO 9 Equifax. 11-point difference. So why is there a difference, right? Well, TransUnion has a 36-point difference, guys. And right now, FICO 8 and FICO 9, in this example, there is a 22-point difference in Experian. Now, why? Why? Because the software is getting more predictive with each new release of the software. So FICO 9 is more predictive. It's a better software. Notice, this is a higher score on FICO 9 here, but TransUnion has a higher score. And then if you compare the FICO 8 and FICO 9 here, Experian has a higher score for FICO 9. So 2 out of the 3 scores are better because they're because of the FICO 9. It is more predictive, and that's why they continue to upgrade those versions. All right? So the reason why we need to know this, it's going to be very important in just a moment. But just remember that your data is the same. It's being filtered through different software, guys. Different software is filtering and calculating the same data. And look at those, 11 points, 36 points, and 22 points. We're getting hammered. And you don't even know what software is being used by the lender. Now, that doesn't count here because lenders don't use this software, but you're going to see why in just a second. Don't stop watching, because I am going to blow your mind about how you've been getting ripped off. All right? Let's take a look at the weighted scores now. These are the weighted scores. So there are 3 versions of weighted scores. Remember, weighted scores are the industry scores that lenders actually use to evaluate whether they're going to fund you or give you financing. So, again, we have FICO 9, we have FICO 8, and we have what's called FICO 542, because back in the day, this is like 20 years old. 542 stood for Experian, TransUnion, and Equifax. Okay? Excuse me. Equifax, TransUnion, Experian. Equifax is first, TransUnion in the middle, and Equifax and Experian is last. So we call it FICO 542. Now, all mortgages currently use FICO 542. They pull 3 different credit scores when evaluating, and they choose the middle score. They don't choose an average. They choose the middle score. All right? So whatever your middle score is, that's what the rate and terms you're going to get on your on that. But they only use 542. When I was back at FICO, we asked them, hey, what's going on with FICO mortgage scores? And they said, we're pushing hard. We believe we're going to get the industry to upgrade to at least FICO 8, which is more highly predictive, right? But, yeah, way more predictive than FICO 542. But it's a huge industry with literally tens and dozens of thousands of brokers and lenders, et cetera. So there's a lot of inertia to move through that FICO scoring, because it's also expensive to use the more recent. Even though it's more predictive, it's also more expensive to make the transition from one version, because it's software upgrades. The filtering software, guys, those are every desk of every mortgage broker or mortgage banker out there is using software in their computer that is 542. Every one of those would have to upgrade, and that's why there's a little bit of inertia. Okay? Now, But auto loans use a 542, and they have auto loans use FICO version 8, and they use version 9. So it depends on where you go and what dealership you're using or which lender you're going to for a pre-approval. You got to know what type of auto loan their software is using, okay? Then there are bank cards. I put up personal and business bank cards here, but the bank cards use 542 and or 548 and or 542, FICO 8, or FICO version 9, depending on the outfit. So don't get confused by Citibank or Chase. I'm just saying these are all the bank cards out there. They could be a community bank. It could be a credit union. Well, I got a couple stories for you about how this works. But you got to know that right now, when you walk into a dealership or a lender, first of all, you have no idea what bureau they're pulling. And second of all, you have no idea what software version they're using. So you have 2 strikes against you the second you walk in. And as a result, you are getting totally played. Totally played. If we're using that basketball metaphor again, you are getting dunked on and dunked on and dunked on over. It's just embarrassing. When you learn this new little thing, the way they're taking advantage of you, A, you're going to have all the power in the transaction, but B, it's kind of, when I found out, I was like embarrassed. I was like, no wonder. This is complete bullshit. What? No wonder. Because I was getting higher and higher interest rates than I thought I deserved. And I'm going to show you why. So let's do a little deeper dive here into a couple of things that you may not be aware of. First of all the weighted scores except for the FICO Auto and all FICO Auto and all the weighted scores for automobiles and for bank cards go from 250 to 900 in their score. The unweighted scores go from 350 to 300 to 850. But all of these, the weighted auto and the weighted bank card scores go from 250 to 900. There's an extra 100 points. So when you have an 830 auto score, that's on a scale of 1 to 900, not 850. You're not near a perfect score. And once again, they give us a little twist of the knife because they don't tell us that. There is no description in here about why they do that or what's going on. That's why I've had people call me up. They were thrilled. They're like, I don't understand this. Client will call in. I'm like, I don't understand. My auto score is 865. What the? It goes to 850. I must be doing awesome. And of course, their advisor team has to kind of remind them of what you're learning right now, because every client, every student learns this. We need you to learn this because you need to know the rules of the game. Remember the scoreboard we talked about, all the different scoreboards from a previous episode? This scoreboard goes from 250 to 900, not 300 to 850. So 250 to 900. Now remember, we have FICO 542 in the weighted auto, FICO 8, and FICO 9. Now, let's take a look. When we're comparing these auto scores, notice the difference. 31-point difference in Equifax, 56-point difference in TransUnion, and 66-point difference between these scores. I can't wait to share this with you. 66-point difference in Experian. Those are multiple tiers. Remember when we talked about in the upcoming episode, we're going to be talking about the credit score pyramid and why tiers are important, because that affects those affect your rates and terms, what you're actually qualifying for in interest rate. Now, the difference between this is that merchants know this game. All right? So we're going to stick on auto dealers right now, but it happens with mortgage brokers as well. So, how is this information useful? Right? We are down in the depths. But hey, you came to me because you wanted to know the damn truth. So we got to bear with the fact that there is important details that are revealing everything. So, and I'm going to show you why this is important. And you better hold on. All right? No joke. No hyperbole here. Better hold on. Now notice, the very best auto score in this example is 702, and it is FICO score 9 with Experian. Remember, those are the two things you need to know. What version of the software is the lender using, and what bureau are they pulling? But the worst auto score is Experian FICO 542. Okay, so what's the big deal? Well, auto dealers will manipulate the spread, guys. They're going to manipulate the spread. So here's what they have. Have you noticed when you go to an auto dealer, they're going to pull 5, 7, 10, 11. They shop you to 11 different lenders, 7 different lenders. Do you know why? Do you know why? And first of all, we'll get into later about how they shred your profile, and we'll talk about the deduping period and how they all count against you once against your score, but it shreds your fundability. But we'll get into that again, another episode. Guys, keep binging. I swear to Buddha. My job is to stay ahead of you and give you content and content and content. All right? So the auto dealers are going to manipulate the spread because the reason why they pull a whole bunch of scores is because, let's just use an example. Here, what you're looking at is they pull 9 different credit scores from 9 different lenders, one who uses each one of the bureaus and the different versions of the score. Am I making sense? Let me say that again. The auto dealers have a pool of lenders that they use who all pull from a particular bureau and a particular version of the score, so that all of these are represented. Now, why do they do that? Well, in this case, auto dealers will pull all the scores and use the lowest score to approve you. They were like, oh, yeah, we got an approval from Barclays Bank. And here it is at 635, and we're going to give you, so congratulations, you got financing. Well, you don't know the difference. You may have kind of that little fracture in your mind going, what? Something's not right. I went to Credit Karma and I had a 720. This is telling me I got a 635, right? The problem is that you need to find somebody who is using FICO 9 and, in this case, using Equifax, because there's a 67-point difference between what the lender is going to, or what the lender that the auto dealer has chosen for you, because they've got all of these scores back. In this example, if they shopped it to 9 different outfits, they got all of these scores back. And guess what? Guess which one they told you got approved with? That's right, the lowest one. But then they get kickbacks and a difference on the spread. They get a referral fee for sending the loan to the lender, and they can get a kickback on the difference in the spread. They make money off of 2 ways, and we're going to be talking about that. There's way too much to cover now, but we're going to be talking about the details of that spread and going into a deeper dive. And I'm going to even be interviewing one of an auto dealer who just wants to tell the truth, right? know how we're being gamed. The reason why we're being gamed, guys, is because we don't know, and now you do. So let me tell you, I'm going to give you 2 tales of success, because you can win a game if you know the rules, right? So let me tell you my first story. So Hannah was our executive team, and as we do with every single member of our advisor teams, every employee and team member of at Credit Sense Funding Hackers, we go through a personal optimization process. And as we did the analysis on her profile, everything, she needed an auto loan to balance out and create her fundability. All right. So we pulled her myfico.com credit report. That's exactly what we recommend for everybody. Myfico.com credit report. The links and everything are going to be in the blog, fundinghackers.com. Click on the blog button, you'll see it. But when you pull that MyFICO credit report, you're going to see all of these versions and all of these bureaus for a total of 28 scores that you can look at and monitor. All right? We do that, all of our students, all of our clients, and all of our subscribers. Now, we want you, if you're going to use a monitoring service, for hell's sake, get the freaking truth, guys. Find out the truth. Credit Karma isn't giving you the truth. There's no correlation between, oh yeah, it's always a 17-point spread between my FICO score and Credit Karma, but this one's free. If you're looking to be fundable, freaking invest in the truth of your situation. Now, Hannah goes in, pulls her MyFICO, finds that her Equifax is her best scores. And so we go, she shops around to her different, the people who she had business relationships with already, bankers, credit unions, etc. We end up at a local credit union here in Salt Lake City, and her job is to do the talking, right? I'm there to backstop because we want all of our team members to just be up on this and be able to coach clients and to coach students in our boot camps, etc. So she asked the question, what bureau do you pull? And they confirmed what she found out on the phone, because we wouldn't even gone in there. She wanted to use her highest scores. So if they would have pulled a TransUnion or Experian, we would have gone to a different lender. They pulled Equifax, but the loan officer confirmed it. And then she asked the next question, which is next and natural for us, and you're learning how to do this right now, but asked, okay, so what version of the software do you use? The credit scoring software. And the loan officer's like, I have no clue. And I said, could you call the underwriting department and just ask which version of the software you're using? Because we want to make sure that if we get a loan from you, that we're doing the best for ourselves, and we just want to know who you're using, which of the versions of the software, right? 542, 8, or 9. Well, she calls up the underwriter, and the coolest thing, because I'd never seen somebody do this before, it was awesome. The underwriter talks on the phone, and the loan officer's like, "Oh, that's cool, thank you." Hangs up with the underwriter. The loan officer turns the monitor around, and up in the top right-hand corner, it said EQ5. What does that stand for? Equifax 542, right? So her best score was exactly what they were using. Now, she had 2 acceptable scores, because remember, scores, we'll learn next time, scores can be in a tier, so a 705 versus a 715 is not going to do anything to improve your interest or your terms, right? So if it's in a tier, you're cool. Well, two of her scores were in the same tier. So when she heard that it was Equifax 542, now remember, this isn't her profile, we're talking about the story, She's like, okay, I want to do my loan with you, because it was within the same tier of her best score. But she knew what to ask. What bureau do you pull, and what version of the software are you using, so that I know that it's the right and best loan for me, right? So that's the cautionary tale number 1. If you're going to go get a pre-approval, she took out the loan and then was able to go buy the car. If you're going for pre-approvals, then you need to know what version of software and what bureau they're pulling, and make sure it's your best savings, that you're getting the best deal possible. All right? Now, The next one. This is Brad, another member, my partner in the business and chief funding officer, and you've already seen him on a bunch of the episodes, right? Brilliant man, knows this game inside and out. So what does he do? His daughter wants a car. I believe it was her graduation, and she wanted to be able to, that was her next level of responsibility, so Dad was going to help her hook her up. She was paying for it, but Dad was all in making sure that she was able to get the vehicle of her choice. Found the best purchase price for the desired vehicle in Minnesota. All right? Maybe it's because it was winter at the time and nobody was buying cars, whatever the facts of the case. The best deal on the car itself, he found in Minnesota. So, he made a deal. Now, this is the next level because you can go get a pre-approval like Hannah did from a lender, or you can use the dealership to do the heavy lifting for you. But this is what Brad did, and it was genius. He told the dealership, I'll tell you what, if you can pull any one of my experience scores, I'll let you hook up the financing, because he knows that there's a referral fee and this and that and the other. But the dealership couldn't play him by offering a nut because he knew what he was doing. The dealership wasn't going to be able to go, oh yeah, I got you approved by a TransUnion score. He said, because all of his best scores were, as we do with all of our students and clients, we teach you how to narrow. In fact, I think it's in the next episode. We want to narrow the range. Remember how we don't want it to be more than 20 points. We want it to be less than 20-point range between your highest and lowest score. Brad's Equifax scores were literally within a few points of each other. So it didn't matter. They were all in the same tier. So he said, if you can pull an Experian credit report and approve me with that Experian credit report, go for it. Because it didn't matter if it was 542, FICO 8, or FICO 9. Didn't matter. They were all close. And so the dealer said, yep, I'll do that. And so he let the dealer arrange the financing. So him and his daughter literally fly out to Minnesota. The financing was ready, signed, sealed, and delivered, and they drove the car home together. Okay? Those are the two ways, pre-approvals like Hannah, or let the dealer manage it. But notice, Brad knew what it took to get the best financing possible and limited the scope of the type of lending that the dealer could go acquire on his behalf. You see what happens when you know the rules of the game. Okay? So guys, don't let the point differ. Understand. Go to myfico.com and follow the links that are in the blog. Go to myfico.com, subscribe to a credit report, and get all of your scores. You will see that all of this data is available to you, and now you know how to interpret it. You now know how to use it on your behalf. You know what a FICO score is. You know what a FICO score is, and you know what FICO scores are. You know what the spread is. You know what a dealership is going to try and sell you. Get you approved by, because now you know the rules of this game. This is why we spent some time in the weeds, okay? This is why we're getting a little techno-babble, because when you know the rules of this game, you will be able to pick the best financing, the best opportunities, and limit the scope of anybody who's trying to get you approved, because you know how this game is played. Pretty awesome, right? Come on. I love this stuff, right? Now you know. Go to fundinghackers.com, click the blog, look for this one. You'll see the graphics. Watch the version of it that's the video version of this. Guys, keep binging. There is so much to learn, and we want you to be able to follow this blog for the hundreds and hundreds of episodes that we're going to be doing, because we're just scratching the surface. We're literally just figuring out how to play the game, not how to master it, and every time we're given the ball to dunk on the lenders. All right? This is Merrill Chandler, your host of RUEffable.com, and I will see you on the next episode. Hey guys, thank you for listening to RUEffable. Please leave comments, because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.